So let's take a look at the property news with Joe Joshi, and this week a mortgage special with Bob Singh from Chess Mortgages. Gentlemen, good day.
Good day. Good morning, Paul. Good morning, Bob. Yeah, I think it's a Bob show by the sounds of things. The mortgage rate is doing a phenomenal thing in the marketplace. So I'm going to stay quiet, I think, because everybody has enough of me every week. So let's see what Bob's going to say.
Yeah, this is we'll start off with the reason for bringing Bob on, because it's interesting to see that a number of the major players are getting into the sub 4% deals. And let's just give a little bit of the background for those before we ask Bob for comment. HSBC lowering selected residential and buy-to-let rates with some sub 4% deals available for first-time buyers, existing customers and home movers. For first-time buyers and home movers, 2, 3 and 5 year fixed deals with no fee and standard deals between 60% and 75% LTV have been lowered, but select 2 and 5 year fixed rates at 90% and 95% loan to value will be upped. This also applies to the energy efficient first-time buyer range as well. Pricing for existing customers, first-time buyers and home movers starts from $395 for a 5-year fix rate at 60% loan to value and 3.92% for a premier customer deal. On the remortgage side, 2, 3 and 5 year fixed deals, both fee saver and standard deals between 60% and 75% loan to value have been cut. This includes its 5-year fixed rate premier exclusive deals. Remortgage rates begin from 4.59% for a standard 2-year fix rate at 60% loan to value, 4.49% for a 3-year fix, and 4.24% for a 5-year fix. Bob, let's just talk about that, and they're not the only people. Obviously, Halifax and NatWest have also got into the market, to say the least. Bob, what's your view on what's going on at the moment?
Good morning, guys. Yeah, it's very, very positive news, of course, because HSBC were the first out the traps, first bank to announce a sub-4 interest rate, then quickly followed by Halifax, Santander, Barclays, and now Barclays are the lowest 5-year product at 60% loan to value. Now, bear in mind, these are headline rates. These are not first-time buyer products, because for this, you need a 40% input, a deposit. So they're not for everyone, but if you've got the wedge, or if you've got the equity, then it's been a long time since we saw a sub-4 rate. So it's good news from that viewpoint, and more will follow. Santander also joined the pack last night as well.
Yeah, because that's a fairly hefty down payment, isn't it, in terms of your deposit, 40 odd percent or thereabouts, 40 to 25%. That's nearly half of the property value, which I guess very few, unless of course there's the bank of mum and dad that comes into the equation, doesn't it?
It does, but as much as parents do help, nobody really wants to put too much money into a property. Really, parents will help with maybe 10 or 20% top end, because obviously in our part of the world, properties aren't cheap, are they? So I think it depends where you are. If you're up north, yeah, this deal could work, but obviously there are some minimum loan sizes applicable to these sort of rates. So this is more headlines than I think. It's really for the upper end of the market, those with, who are going to do remortgages soon, and they have equity left in their property.
Yeah. What about that idea that those that need a 90% loan to value, those rates are going up, but those with more to put down, their rates are going down? Is that something you've seen before, or is that a new phenomenon?
That trend is reversing now, thankfully. Even the 90% rates are now, very, very attractive. So it's getting better all the time. The 5 and 10 year money markets are telling us the 5-year and 10-year swap rates are about 3.6. And that's why you've seen these rates come down to 3.8, 3.9, because they're still making a 0.3% margin above the swap rates. So, if swap rates keep on going down, then yes, these rates will get even better.
And Joe, that's good news, really, isn't it, in terms of what we talked about last week, which is a year of two halves, because, we've had the slow first half, and now the second half of the year, it's not only been boosted by the 0.25% cut in the base rate, but now we're getting these more comfortable longer-term fixes for people to have a go at.
Yes, good morning, gents. The thing from my point of view is that the property market is the market that gets always stoked and stroked because it generates that quick fix situation for pretty much every government. Not to say that it also does the same for a lot of potential buyers in the marketplace. It gives them a real sort of boost of energy to say, look, this is a window of opportunity. I'm going to do this. And this particular government came in with that in mind when they started to say that the housing market was the one that they were going to actually stir up quite quickly. With planning changes and, of course, the given by the Bank of England of 0.25% down, all helped what was about to happen. Now, obviously, there's going to be a sting in the tail. As we all know, there'll be probably tax rises, etc. But the main thing is you've got to be in it to win it. And as Bob says, that if the swap rates stay where they are, then yes, the fixed rate and long-term fixed rates will probably be attractive. I don't, obviously, as you know, Paul, I don't believe that we're ever going to see a sub 5% base rate. But I think the general attraction that will be there for potentially first-time buyers and remortgages, and of course those that have got big deposits, will actually be very attractive. In that sense, it's a very, very attractive time. It's a great time for pre-Christmas present, if you want to call it that. And it may get better, especially if some of the rates come in. So that gets us our second half that we talked about. The first half was a little stationary, but coming out of the runs in September after the schools are off, etc., that last quarter could potentially be a good quarter for the property and the remortgage market.
Let's get Bob's view on that. You're famously quoted as saying, Joe, that you don't think that rates will further fall before the end of the year, and you're saying that you still think they'll stay around 5. Bob, what's your view?
I partly agree with Joe, but I think rates will fall once more. And the only reason I'm saying that is because America isn't doing too well. They're on the verge of a recession. And if they start cutting their rates rather aggressively, then I think we'd have to follow suit.
Interesting. So you think there's going to be another base rate cut, presumably, what, 0.25% this before Christmas?
0.25%, yeah. Again, we'll be watching America very, very closely because they will try anything or do anything to stave off any recessionary fears. And the only way they can really do that is cut their rates sharply. So, we're never going to be too far out or too far behind them if they start cutting aggressively. So that's the only reason. Otherwise, there's no real reason because mortgage pricing isn't based on base rate. It's based on swap rates. So if the market thinks rates are going to fall, the banks will, charge lower rates irrespective of what base rate is.
So what are these rates that we're talking about? We've read a few of them out here now, somewhere around the 4% mark and just under 4 in some cases. What is that telling you about where rates will be over this next, say, 5-year, 2, 3 and 5 year period? Where do you think we're going?
Yeah. My own prediction is by the end of 2027, base rate will be down to 3%.
Interesting, interesting.
Yeah.
Your thoughts on that, Joe?
I would love to agree with Bob on that, but my view is that this is where we tend to suffer every time those rates have been brought down. We actually have a false base, and then what happens is people start to live their lives based on that, and then we have an increase in inflation, and then we have the tightening our belt situation. And if they can sustain that base rate around the 5, which should be the new norm, I'm not saying that that's perfectly sound from my own pocket, but just generally speaking. And of course, the base rate stays there, and the swap rates are there, which allows fixed rates for mortgages to be a more flexible, I think would be a great combination, because the mindset is never the swap rates. The public actually never understands swap rates, and they don't really look at that. They just look at what is the Bank of England saying. If the Bank of England says it's going to be 5% or 4% or whatever, they start to work their life based on that sort of thing. And that means if they've got cash, a liquidity available because the rates have gone down, they will then go out and spend on the same basis. And then we have this continuing cycle that we then suffer, and people, get into a stage where, repossessions happen or repayments are fallen back, etc. So that's my only reason for thinking that the new norm should probably stick around 5%. But The public isn't educated with swap rates, and they don't understand that unless and until they actually sit in from someone like Bob, who then explains to them why it is that they are getting a lower fixed rate for a short term, and that they should also look at perhaps refinancing in 3, 5, whatever years they actually fix it for, not allowing for the actual costs of redoing that as well. So overall, it's probably going to be around that sort of level. Not that I'm a mortgage advisor, which is why we have Bob come on and join us to make sure that we advise and give the guidance correctly.
And looking at the NatWest offer, Bob, they're offering a sub 4% mortgage deal directly to consumers, which has raised concerns among brokers. NatWest is offering an online-only 5-year fixed-rate deal at 60% LTV with a product fee of £1,495, and that's at 3.97%. There's a minimum loan of £250 with early repayment charges, starting at 4.5% in the first year, falling to 4.25, then 2.5%, and finally 1%. Deal is one of the cheapest on the market, following Nationwide bringing out a 5-year fix at 3.99 at the end of July. Is this the first time we've seen these direct to consumer loans and sort of bypassing people like yourself?
Yeah, there was a lot of talk about NatWest cutting out the broker when giving out better deals. NatWest are known for doing this. They've done it before, and they're not going to stop. So, every bank has its own offering, particularly to their premier clients anyway. So we're used to that. And what they're doing here is basically, instead of paying us for the introduction fee, they're just passing it on to the client directly. Because we know customers don't go to banks directly typically. Yeah, they don't like dealing with banks as a rule. That's why 85% of the mortgages arranged are through advisors. But, so they have to do some lending themselves as well. They can't just be purely intermediary led as a bank of that size. They have to be doing something through the branch as well. So they deploy these tactics then to attract customers without the intermediary channel being involved. That's all.
Yeah, because as you say, I mean, it is disappointing considering how much of a number of introductions that you as brokers do to banks in general.
Yeah, they forget that. They really forget how much we support them and, do their work for them, in fact, bring the customer to them. But they still do these underhand tactics to get business directly.
So it's been a while since we last spoke to you. Just give us a resume of, if I'm a first-time buyer coming to you now, what's the situation like in terms of? I mean, last time we spoke, it was pretty tough. There was the credit element of it was a big worry for people. There was the stress testing was much greater than it had been in the past. Where are we now? Has things eased a bit? Is it easier now if I'm a first-time buyer coming to try and get on the housing ladder?
Marginally easier, only because lots of products have been invented this year, which hadn't been announced last year. I'll quickly run through them. As we all know, Help to Buy went by the wayside, and hopefully that will come back after the October budget. But a new lender came on board where you only need £5,000 deposit. You don't need 5% or 10%, just £5,000, and income multiple of 4.49. Call it 4.5, then that you can actually buy a house with just £5,000. And as we know for first time buyers, there's no stamp duty up to 425,000. So very little other costs involved really. With £5,000 or £6,000 or £7,000, you could actually get the keys to your house if you're buying within those income multiples. You've had the Own New scheme come out, which is only done by a few larger developers, and for that you need a 1% deposit, and the rates are like below 1% for 2 years. So that's another good scheme which first time buyers can avail, is to go on the Own New scheme. It's a new build only. It's not offered by every large developer, but there are, I think, 3 or 4 now joining ranks, and the mortgages are only available through 2 or 3 lenders as well at the moment. But the rates are pretty cheap, so it gets you through the door. And shared ownership is still there, but the biggest change is the availability of credit. People, lenders are prepared to go and push the boat out a bit more at the moment, lending as much as 5.5 times income for first-time buyers and 6 times for professionals. Now, the FCA has scrapped all the affordability guidelines, but lenders are still following them as if they're still in place. So it's getting easier, but we try and educate buyers to make sure their credit is kept up to date. They don't have any untoward entries on their bank statements. They're not too much indebted at the time of application because that affects how much they can borrow. Ideally, eliminate all borrowing before you actually put pen to paper. So it's getting better. So we're seeing some changes, and we maybe need more products, maybe longer term fixes coming into play, 10, 15-year products. But we're saying don't fix just yet because we do expect rates to fall uh, to around 3.25, 3.5 in 2 years' time, and then that would be the time you'd fix for 10 or 15 years.
So where are we with things like lifetime mortgages? Joe and I have discussed them quite a bit recently. The notion that you might actually hand a mortgage on to your kids.
That's not available just yet. Okay, not that I know of. But lifetime mortgages are, in our world, more to do with equity release type for elderly people. But there are now instances where if parents took an interest-only mortgage 25 years ago and didn't do anything about it, didn't invest elsewhere, or didn't build up any savings to pay off that mortgage when that mortgage was going to end, they're now having to add their children onto the mortgages to get longer term. Otherwise, the prospect is, selling the house or downsizing, which many don't want to do. So, we're seeing now children supporting parents. So it's really, if that's what you're talking about, yes, that's happening more and more.
So let's take a look at our second story then, and this is really looking back at the year that's just gone from a mortgage broker's perspective, because there's a report saying that the reported revenue from regulated mortgage broking services fell 13% from 1.58 billion in 2022 to 1.37 billion last year. This is from the regulator. Financial Conduct Authority, the FCA's retail intermediary market data for 23 showed that the commission earned from mortgage business amounted to 1.06 billion, down from 1.23 billion in 2022. Some 293 million was generated from fees and charges in 2023, lower than 330 million earned over the year prior. So pretty much a tough year, and reflected, I suppose, by those 14 consecutive interest rate rises. Is that a fair assumption of the year, Bob?
It is, yeah, it is. Mortgages did at one time become, very unaffordable. It was not good news for those people that were coming to the end of their products when the only option was a 7 or 8% product. Um, so yeah, the market was put off by the high rates. But let me just put these figures into context, because this is regulated products. This means owner occupied to live in type mortgages. They're not. This does not include buy-to-let or bridging or commercial finance, which some brokers also have in the mix as well. So it's understandable, yeah. But it's not a big fall. But also the number of brokers fell as well, so that had something to do with it. Leaving the market, because it's a very regulated uh, area, and the FCA are quite sharp on making sure things are done the right way, which is a good thing.
So was that? We did notice that in there actually. Yes, the numbers of brokers had gone down. Was that because some of them had gone to the wall, or was it just the fact that it was too difficult to make a living?
Um, no, some people just can't make the numbers work in this business. It's it looks lucrative from the outside, but when you actually run a business, you realize how expensive and how difficult it can be. Um, but no, I think it's a lot of people are retiring. A lot of people are leaving the business because they've been in there like me. I might pack up my laptop in about 5 years as well. So, we're coming to, and a lot of people aren't coming into that business because there's not really any proper training programs or anything like that. You come into the business, pretty aimlessly, really, and take your chances. There's no apprenticeship type schemes really that really stand out where new blood is brought into the business. Um, but yeah, things might change in the future. But certainly at the moment, um, broking is still a good business, but it's getting tougher.
That is an interesting point, though, you raised there, Bob, and be interested in your thoughts on this, Joe. I mean, it is isn't extraordinary. It's a very heavily regulated product by the FCA, and yet there isn't any kind of qualification you have to have. You can just literally set up tomorrow.
Well, I wouldn't say that's that true. I mean, that was the case probably 40 odd years ago, when you could change from being a negotiator in an estate agency to a mortgage broker. And most people were brokers in general in their life. I mean, I can recall going, sort of walking in, seeing the branch manager at a building society and saying, here's an application form. And it was kind of dealt with at that point. There was no such thing as it's got to go to somebody else and then it's somebody else and it's got to do this. It was just a case of, well, yep, that fits within my criteria, and I'll stamp that and off you go and get a valuation, and the money would be in the account in the next 10, 15, 20 days or whatever. That was how it started, and it sounded very attractive. Of course, there was fees to be made, but as time has gone on, Bob and people like Bob who have had a longevity in the business have had to sort of learn the ropes and get past the Financial Conduct Authority and make sure that their business is authorized correctly in order to stay in the game. And that's probably where the change comes, because most people are not administrators, they are more salespeople. And this is now become, to the best of my knowledge, a very much an administration section where all the T's and the I's have got to be constantly crossed. Hence why there is lesser attraction of the sales type chap who wants to come in and build his pipeline and get lots of people in to do the mortgages because he thinks he can. It's not as good as it was. And of course, the magical computer says no comes into this. And that's when you need the brokers. Whereas when they go directly to the lenders, that's the end of their journey. In fact, it's the end of their journey in most cases for a lot of reasons. Because if they go directly into a branch and say, I want to apply for a mortgage, and the computer says no, that's a marker that's gone on their credit anyway. The fact that they've been told they can't get this. And then it's even a steeper, higher climb for a broker to be able to try and see if we can get that curve back into some sort of play.
You just need the CMAP exams to start advising in mortgages. But mortgages are, in my view, quite over-regulated. There's not much that can be misadvised in a mortgage apart from just a 0.1% difference in a rate or something like that. So that's the way it is. And the industry's blossomed out of that regulation. Yes, obviously we need, all want consumers to be protected and make sure they're not given the wrong product. But there's very little wrong advice you can give, really, apart from maybe not the best rate on the market, or you might give them an interest-only mortgage when really they want a repayment mortgage. There's only two of those things that can actually go wrong. What else can go wrong in a mortgage?
Yeah, it's interesting. I remember when last time we spoke to you that we were talking about the fact that sometimes the products would change. Every 14 days something would be off the shelf and then it would be back again. And I was going to ask you, how do you keep on top of that sort of pace of change? Because there's so many products out there, and you're relied upon by customers to get the right product for them. How
Absolutely.
do you do all your research as well as advise people?
Our sourcing systems are real time. So whenever lenders change the products, the sourcing system is updated. And on top of that, the most important thing is if rates fall after the mortgage offer has been issued, then how do you monitor those? That's the more trickier bit. And then for that, we've got software as well. So whenever an offer is issued, we enter that onto our system. And if that lender then subsequently lowers their products, we get alerted, and then we can switch the deal to a lower rate, providing we've got enough time before completion. So that's now quite a lot of our work, because anytime we might have 30, 40, 50 offers awaiting completion, and making sure the client gets the best rate from their lender is quite a challenge.
Let's just talk about remortgaging for a moment, because obviously that's been one of the big stories of this past 12 months, and that is the fact that so many people are coming off the back of 5-year fixes that may have been at 2% or something in that sort of region. and now they're looking at sort of double that, and some of these jumps have been horrendous. Where are we
Yeah.
in that whole scheme of things now, and what's your advice to people who might be facing this dreaded prospect?
Uh, My advice is start looking 3 or 4 months before the actual rate ends. See what your lender is offering you versus what the competition might be offering, and just keep monitoring that. And if somebody's giving you a far better deal than what your current lender is offering, it makes sense then to jump ship. But you don't have to take the new offer just in case your lender comes back in the play and is better. So you keep your options open as long as you can, but start looking and sorting things out 4 months before. Now, many lenders let you take options 6 months before the rate ends, which is okay in a rising market. But when the rates are falling, you want to leave it as late as possible, I feel, because the later you leave it, the more prospects you have of getting a better product. But you need to stay in contact with your broker, keep monitoring the situation, and then take their advice.
So let's just talk about our final product story this week, which is basically going back to the King's speech and the initiatives that are being suggested that this new government's going to put in place. We're talking about the Affordable Housing and Renters Reform Bill. We're talking about Planning and Infrastructure Bill and First-Time Buyer Support Bill, along with the Leasehold Reform Bill. So those are the things that are in the speech. So you've got the Planning and Infrastructure Bill, which is designed to streamline the planning process and boost infrastructure development. The bill aims to facilitate quicker project completions by reducing bureaucratic hurdles. Then on the first-time buyers support, you've got mechanisms to assist first-time buyers. Tax breaks and financial incentives will make home ownership more accessible, designed to increase first-time buyer transactions and necessitating tailored advice support. The Leasehold Reform Bill, I think we've probably covered that in the past, focusing on the improving of the leasehold system. They'll make significant changes to protect leaseholders. What's your view on what was announced in the King's speech overall in terms of trying to improve the whole process of buying a house and selling a house?
If it all goes through, I think it will make a positive impact. We definitely need more housing. Obviously, the government have announced a fairly unrealistic target of 1.5 million. We know it's not going to happen because it's not just that the labour is not available, the materials aren't available. At the moment, there's a shortage of bricks in the UK. You have to get them from China. So, that's going to be a struggle. And for each year that 300,000 target is not met, it just makes the remaining 4 years even more difficult. But the changes around first-time buyers, I think, is the key issue here. We need to maybe invent more schemes and more methods of getting those people on board through cheaper housing, more innovative products on the mortgage side, maybe giving as much as 6 times income, maybe allowing first-time buyers to borrow on interest only for the first 5 years, just to get them on board, because the whole thing is affordability. The desire is there, the income is there, but the calculations sometimes don't let the person buy the house that they actually want to live in. So I think we need a wholesale review of all this. I'm not sure how successful that's going to be because governments rarely listen to brokers anyway. They they tend to form their own opinions. But I do feel there does need to be change. Uh, Help to Buy needs to come back. Definitely, that'll spur on the new builders and that sort of thing. And hand in hand, affordability needs to be relaxed for first-time buyers.
I guess if you make houses more easy to buy and more affordable, then does that not have an inflationary effect yet more on the price?
It does. So it's a fine balance, isn't it? So this is what the government's got to deal with. They're paid to do that. We're not. So let them think about it.
Joe, what's your thoughts on what's being announced in the King's speech? I know we have talked about the King's speech, but these particular bills, do you think they're going to get them all through in the time?
I think some of the bills that are there, Paul, are very challenging. I mean, from a selfish point of view, obviously, I would love to see as much as possible stuff going for the first-time buyers, because without them at the first run of the ladder, we are just not going to move the rest of the property. That's the system that we live by and have lived by forever and probably will continue to do that. It is the motivation of the first time buyer. So, like Bob says, the variation of products and the variation of credibility should really take into place because times have changed so much. We still refer back to things like three times income and 3+1 or 2.5 times joint, and okay, some of that's to 4 or 5% now, but they really need to take that up to maybe 6 and 6.5%, and to make sure that those people can afford that. So there is a little bit of a stalemate in the system for that part. And so that is probably important. The others will follow, but they all follow when the first time buyers get on the market. So lease reform will happen. Obviously, planning is something that is general, that is across the board. And I think that's going to be a very big challenge for them, as much as they think it's going to be easy to go and put green belt, grey belt, blue belt, and any other color belt that they can find. It only causes a problem. I know from my point of view, the number of people that were sitting on property that now all of a sudden think, well, actually, the government said that they're going to allow some parcels of land to go. I'm neighbouring a green belt, so I'm going to sit tight. So they, are sitting on the hope that in the next 3, 4, 5 years something will change, but actually it stops the whole thing as far as that's concerned. So I think the first time buyer products are definitely the most important products there is. What I'd like to ask Bob, while we have Bob's attention today with us, is the buy to let market. And that market is just gone through a hole, really. And does he see that there is some revival in that market? Because to be honest with you, part of this policy of building new homes and finding renters reform and build to rent and all those other things are just not going to happen unless investors or creative funders come up with a product which is going to allow the buy-to-let market to come back into some sort of fold. Because at the moment, they're leaving in droves and coming in very, very slowly at this moment. What are your thoughts on that, Bob?
Yeah, spot on, because the buy-to-let market is now really going to be the domain of the professional investor. It's not going to be for the faint-hearted because of the changes in tenancy laws proposed in terms of longer-term tenancies, harder eviction. I mean, you've got to prove that you're in hardship to get your property back. So I think if you are going to go into that game now, don't expect your property back because it's going to be very hard to get it back unless you want to sell, of course. So I think these changes, which are all pro-tenant, should really be reviewed, and the landlord needs to be given some powers as well. At the moment, it's putting people off. The taxation is bad. Everybody has to now buy in a company name really to be really tax efficient. And those that are holding properties in their personal name, who for some reason can't transfer ownership from personal to limited, and we can help you on that, by the way, but they're leaving the market as well because the taxation is just too high for them. We're not incentivizing landlords to come into that market. And I guess from what Labour is proposing, any large development is only going to be reserved for first-time buyers, and overseas investors and buy-to-let investors will be excluded from buying those assets.
It does
So
seem that they're trying to, as you say, get rid of what Joe and I call accidental landlords, and just have proper institutions that are set up specifically for multiple hundreds and hundreds and hundreds of buy-to-let type properties, isn't it?
yeah, I mean, there was a better way of doing all this. I know George Osborne introduced the Section 24 changes, which sort of forced people, into the company route. But there would have been better ways to monitor landlords. And if the idea was to catch people who aren't declaring their incomes, there was a better way of doing it. I just think they didn't really think about the long term effects of all this.
Don't you think that,
Sorry, come on.
sorry, Paul, don't you think that by taking the buy to let market out, Bob, and those landlords out, I mean, whether it's this government, previous government, or a successive government, have actually desperately shot themselves in the foot
I agree.
on the basis that there is now such a shortage of rental property. And we talk about mortgages and we talk about first time buyers, but what
Mm.
we forget that these renters, people that are coming in who can't afford to get on the property ladder, actually are paying now absolutely astronomical rents on the basis that that's the shortage of property. The supply and demand factor has kicked in so heavily into the buy to let market that all of a sudden people actually are paying. I mean, it's just astounding some of the rents that are being paid. I mean, I was told recently that, it's nearly a 900 to £1,000 a month on a room rent, let alone a house rent, where there was a time when you could have rented an entire flat for, or maybe even a two-bedroom flat for that kind of money. But now
Correct.
we're talking about just a roomlet. And I think they desperately need to look at the buy-to-let market. But looking at institutional ones, maybe that is that is the creation that we've got to look at and create the fund, Bob, for a corporate setup with institutional people being shareholders and buying up the blocks that they want to manage and do it through a corporate section and still
Yeah.
brings in people that want to invest in that market. And that's what the institutionals are doing. I mean, I'm getting a lot of calls from institutional people who are saying, well, we'll buy a whole block, or equity companies that are in the city are throwing money at this. And if you look at people like Le Monde recently, who have literally come into the market over the last couple of 3 years, have built portfolios of, thousands of properties, which they've now brought under their belt and purely manage them under institutional basis. So the single, accidental landlord who's got two, three, four, maybe five, is actually being pushed out of the market. But actually, we need those people back in the market to a large extent because there's going to be a huge shortage. So I'm not sure how that would work, but I think they've definitely blind spotted a buy to let market. That's just a view that I think is quite
Yeah.
strong. We need to focus on the first time buyers, but we also need to have some sort of strategy for those that can't be first time buyers who are going to end up having to rent for perhaps another 5, 10 years.
No, absolutely, and it's hard to save when you're paying such high rents anyway. I mean, Lloyd's Bank are entering that sector. John Lewis are converting, many buildings into residential apartments. So I think the institutions will have quite a major part to play in all this in the coming years. And you're right, government has shot itself in the foot because instead of encouraging private landlords to buy stock and house maybe DSS type tenants, if there's no landlords left, they're going to have to build them houses, much quicker than they anticipate, and that's not going to happen. So the rents will go higher and higher and higher.
And it's interesting. It does seem that both or governments of both colours that we've had both seem to agree on the same thing, don't they? They both seem to want to get rid of the accidental landlord.
Yeah, but what these landlords will sell up or sell isn't first time buyer stock anyway. In the majority, first time buyers want sub 200 stock, and there aren't that many parts in the country where there's 200 stock anymore. It's all up north, isn't it? So either you say, look, all first time buyers move up north, uh, and
We've suggested that and hinted at that quite a lot on this program, actually.
and leave the real money for the southerners, but that can't happen, So I think it needs joined up thinking. I think it needs all the stakeholders to come together and really give it a good hard discussion and then go forward.
Lovely. Well, Bob, as always, thank you so much. Bob from Chess Mortgages, of course, and you've seen his number on the screen. We'll just give you a little quick. There is his number and his details on the screen. Bob, as always, thank you so much for all your wisdom, and it's great to have you pop in and join us on the show on a regular basis, and thank you for that today. A bit of a mortgage special on this week's edition of Property Matters.